Welcome to this lecture, IFRS 11 Joint Arrangements. IFRS 11 Joint Arrangements. IFRS 11 Joint Arrangements. This standard sets out the guidelines for the classification and measurement of joint arrangements. So if you want to understand what joint arrangements are, you read IFRS 11. It gives classification. Now, a joint arrangement exists when each party can contribute in different ways. So, joint arrangement implies you have 2, 3, 4, 5 investors jointly controlling an entity. Now, the focus is on how each party to the arrangement accounts for its interest. Joint arrangement, where two or more parties have joint control. So, you understand. So, if we have entity A, B, C, and they agree among themselves that they will control entity D, then entity ABC are parties to a joint arrangement because they have joint control. And joint control then means that contractually agreed sharing of control in which decisions require unanimous consent of all parties to the arrangement. Unanimous consent. In fact, this is the term you must look out for when you are reading IFRS 11, unanimous consent. It means if A and B jointly control C, A cannot take a decision alone, B cannot take a decision alone. The decision must be agreed to by both A and B, unanimous consent of the parties to the joint arrangement. Now, we'll find out soon that we have joint operation and joint arrangement. Now, with joint operation, the parties have rights to assets and obligations to liabilities relating to their joint arrangement. But with joint venture, they have rights to the net asset. Here, in joint operation, there is rights to assets and obligation to liability. So you identify your assets to the arrangement. You identify your obligation to the arrangement. You must take care of your assets and your liabilities. But in joint venture, you are not interested in any asset or any liability. You only need the net position. So it's like the entity should do whatever they are doing and tell you what is left. That's the joint venture. We will discuss it further. So IFRS 11 classifies joint arrangement as joint operation and joint venture. Now the classification depends on the rights and obligations of the parties to the arrangement. So if I enter into a joint arrangement with you and I agree with you that you take part of the asset and I'll take part of the asset. You take part of the liability and I'll take part of the liability. Then we have a joint operation. But if the agreement is such that we agree that we will set up an entity and the entity will do the business and we are only interested in the net asset, in the profit that is made at the end of the day. We don't care what asset they acquired, then we are talking about a joint venture. So joint operation gives rise to assets and obligation to liabilities. Normally, there is no separate entity. Normally, no separate entity, which means it could be there. No separate entity is established. So it's like we decide that we are building a pipeline that we'll use. Okay, so I'll buy the material, you can bring the labor, so we are sharing. And then when we build the pipe, my water will pass through the pipe, your water will pass through the pipe. You see, so we have a share in the assets and a share in the liability. I will account for my share of the asset, I will account for my share of the liability. You account for your share of asset, you account for your share of liability. Okay, so sometimes we don't need a different entity, we don't need another company to do this. We can just do it by agreeing and bearing the cost for the assets and assuming the liabilities. When it is joint venture, it is right to net asset. So you must always ask, what is the arrangement? What are the contractual arrangements? Is it right to assets, right to obligation to liability? If you answer yes, it is a joint operation. Is it right to net asset? If the answer is yes, it is a joint venture. Now, joint venture is structured through a separate entity and may be joint operation or joint venture. If you have a separate entity, it is a joint venture, but it may also be a joint operation. So we are trying to say that the separate entity, joint operation is not always a separate entity, but sometimes may be a separate entity. But a joint venture, there will always be a separate entity. For joint venture, there will always be a separate entity. Now, parties to a joint arrangement must assess the terms of the contract. So it's an agreement, it's a contractual arrangement. We must agree, and it may be through the minutes or bylaws. So like it's a written arrangement of what we want. Okay, so it's based on the existence of contractual arrangement. It may be a contract, minutes, bylaws, etc. And the classification must consider the structure of the arrangement, the contractual terms, the legal forms, and other facts and circumstances as may be present to the investors. Now, how do you account? How do you do the double entry? This is the question we are answering. When it is joint operation, remember the parties have rights to assets, obligations to liability. So they account for their rights to assets and they account for their obligation to liability. So if I am a joint operator, I'll take my joint operator asset and add it to my assets which I have already. My liability will be added to my liability. So it is a line by line addition of its interest in assets, liabilities, expenses. So if you take the profit and loss account, my sales from joint operation will be added to the sales. My cost of sales from joint operation will be added to cost of sales. My expenses from joint operation will be added to the expenses. My assets from joint operation will be added to my assets. So line by line, operator recognizes or adds line by line interest in the assets, liabilities, expenses, operations. And so if I'm preparing a consolidated financial statement, the same thing will happen. I will add it all up and consolidate. Now, with a joint venture, remember, you have to apply IAS 28 equity accounting method. So there you have to initially, with joint venture, you initially measure the investment at cost and then you add or subtract the investor's share of post acquisition profit. Okay, so that's what we are talking about. Now, the rest is using figures or being able to explain. Now, again, let me emphasize, you must read, you must tell your story. Look, you should be able to say IFRS 11 is about joint arrangement and it gives joint control. Joint control is a contractual arrangement where the parties unanimously agree on managing or running the activities of the operation. It may be a joint operation or a joint venture. A joint operation, parties have rights to assets and obligations to liability. And with joint venture, the parties have rights to net assets. Let's now do the reading and then if there are questions, remember, feel free to ask. Thank you.